There has been a lot of regulation change in the market. We've already discussed all of these in terms of the changes in land transfer tax, to the flipping tax, to the extended foreign buyer ban. But the federal government has actually just made a lot of announcements. So the federal government announced a 30-year amortization for new builds that are CMHC insured. CMHC will not insure any product that is over $1 million. So this is really capped to the entry-level market, and it has to be a new build under $1 million. Not a ton of that product in Vancouver unless you're thinking one bedroom or potentially two bedroom condos, and maybe more so outside of the downtown core. This will definitely help markets such as in Alberta, where you can buy a brand new house under $1 million, a detached product. So that's fantastic. 30-year amortization means that you just get to spread your mortgage over 30 years instead of 25. Why I don't think this is going to be a huge change to our marketplace is because 30-year amortizations are already available to anyone who is conventional, putting down 20%. It's not a massive change. It's just another positive in the right direction, so to speak, to make homes more affordable under that $1 million mark. Of course, it's a blessing and a curse every time the real estate market goes up. It's a real challenge for the Bank of Canada trying to manage inflation because home prices are factored into the inflation rate. There's also going to be a crackdown on mortgage fraud. So they're now talking about CRA and mortgage brokers syncing information and verifying the incomes of buyers to try to remove the bad actors from the market space that perhaps lie on their applications and secure financing to accumulate more and more properties. Let's say speculators in that regard, or investors, a sub-segment of those, because obviously 99% of the people out there that are investors are buying these properties and renting them out and creating rental product for people to live in, which our government hasn't been so successful at doing. The federal government has also announced a $6 billion fund to cities that are going to allow the 4 to 6 units multiplex development on single family homes. We've heard a lot about that because that's something that our BC government has announced, but now it looks like the Fed is really trying to follow what BC's David Evy's government has been proposing to help create that densification and multiplex living more prevalent to hopefully make housing more affordable. If you walk down the streets of Europe, which I think most people will agree are beautiful, you're going to see that pretty much everywhere you go. This is not a new concept. So if you love Europe, you might actually love what can come out of this. There's ways that you can make this look quite beautiful and create more housing for a lot more people. Federal government is also following along with providing $40,000 loans to homeowners that want to create additional suites in their home for their family, multi-generational homes, or potentially investment to provide more homes for people, something that our city has already done. So not a lot of people have taken advantage of it. So we'll see if that does anything. Of course, the carbon taxes come into play starting April 1st. So some more expenses to your bottom line on everything that you do, from gassing up to heating your home. So in summary, these are regulation changes that have been announced in advance of the federal budget. But also, there's a lot of inflation that's happening in our general economy. And I actually think that one of the regulation changes, which was the creation of the underutilized housing tax, is actually a great example of things that people should consider when we think about our administrative costs and our growing government expenses. Here we have inflation. So it's been heading in the right direction. You can see our 2% target here. Here was the peak back in 2022. We are trending down across all measures of inflation, which was very positive. What happened the other day, about 4 days ago, is the US announced that their inflation grew a bit more than expected, which kind of threw market participants off. The bond rate that we follow for the 5-year fix has actually increased. So the US, the stock market pulled back, the bond market increased, and we see that reflected in the 5-year bond yield. As you can see, here's January, it trended down, and then February was 3.75. We were at 3.79 earlier this year. That was at February 13th. It had dropped a little bit, but now it's climbing back up for April 15th here for 3.7. So it was looking like fixed rates had come down a little bit, but this week we're expecting fixed rates to bump up 5 to 10 basis points. So it feels like where we are with interest rates are going to be a little bit sticky. We can't really depart from where the US is sitting, because if the US stays strong or increases their interest rate, it's going to make for a very strong US dollar. And then everything that we import via our Canadian dollar is going to be even more expensive because it'll take more Canadian dollars to buy those US goods. And therefore, it will cause inflation, whether we want it or not. I would say if anybody was thinking about seeing mortgage interest rates decrease this summer by the Bank of Canada in Tiff Macklin, I think that there's a very low chance that we're going to see a decrease, especially because we're currently in our spring market and it is a pretty active market with prices increasing. The Bank of Canada has a very, very challenging balancing act between trying to manage the economy and our import and exports and resources being priced against the US dollar and wanting to help our economy by lowering interest rates so people spend more. However, if we lower interest rates, prices will most likely increase further in the real estate market, as well as a stronger dollar will be helpful for a US export situation. But there's all of these balancing acts that Tiff Macklin needs to take into consideration. And I just don't see us diverging very far from where we are today, because really the US needs to get their inflation under control. In summary, we know that the market is driven by consumer confidence. It is definitely there. We've had our inflation decreasing, which is very positive and can give the Bank of Canada the opportunity to decrease those interest rates. However, while our bond market has increased because of the US inflation numbers and our interest rates are now starting to increase in terms of the fixed rate, they're probably going to be going up this week. It's not heading in that downward direction that has been helping, and we are getting the inventory that we so desperately needed. So it's a very interesting time. But in conclusion, we are seeing prices increase. If that's a function of people speculating that interest rates are going to be lower this year, that's a strong possibility. However, I think a lot of people are smart enough to know that they wouldn't be getting into the property market if they couldn't afford the interest rates that they had today. And the fact is there are enough people out there, there's enough demand that's able to get into the market. They're satisfied where today's rates are, knowing that at some point in time in the future, whether it's this year, next year, or a couple of years down the road, rates will decrease. And those people are entering the marketplace. It's not wild and crazy. However, I think that if we do see some interest rate decreases, we will probably see a more active market. However, with the caveat that, of course, the rate decreases aren't happening because our economy is going down the drain and people are losing their jobs, because that also has a negative impact on the real estate market. Anyhow, I'm Christine Kopr with Sotheby's Realty in Vancouver, BC. This is our April market update. If you have any questions about what to do in this real estate market, if you're thinking about selling your home or potentially buying a home, we do need to be prepared. You do need to execute the right plan for this market. And we welcome the opportunity to speak with you. Make sure you like and subscribe our Instagram channel, YouTube channel, and please reach out to us with any content that you would love to see us comment on. Thank you. Take care.